Welcome to CT Guides. My name is Theo, and today we'll be doing a video on small versus large market caps. So we're going to start with an intro to market capitalization, also known as market cap for short. And then we'll speak to the aspects of trading that affects, like liquidity, volatility, market dynamics, due diligence, and risk and reward. So the market cap is the total value of all the coins that have been mined for a specific token, and you calculate that by multiplying the number of coins in circulation by the current market price of this token that you're trying to look at for a market cap. Now, for a small cap token, those are cryptocurrencies that have a lower market cap. Usually ranging from a few million, to a few $100 million. They're generally less established projects compared to large caps, and examples of that would be tokens like Lux, Flux, and Moonbeam. And generally speaking, they're going to be under 500 million in total market cap. For the large cap tokens, those are going to be cryptocurrencies with a very high market capitalization, typically more than $1 billion. And primary examples of that are going to be Bitcoin, Ethereum, Solana, your heavy hitters there. And to finish up, there's also kind of a mid cap range, kind of between the 500 to 1 billion, between the small and the large cap. Those are tokens that are kind of like up and coming, but haven't yet breached the top 100 where most of the large cap tokens are. Examples of mid cap tokens would be Pendle, CRV, and IOTA. Liquidity can be lower for a small cap token. This can result in a wider bid-ask spread and the slippage when executing a trade. So basically what that means is that there's going to be fewer buyers and sellers in the market at any given price. So a market order can be executed at a much different price than originally expected. So when you're trading small cap tokens, I would definitely recommend using limit orders to protect yourself in thinly traded markets. Now, for large cap tokens, typically going to have higher liquidity and therefore a deeper market, and there's going to be a narrow bid-ask spread. There's going to be more people buying and selling at any given price. So it's going to make it much easier to enter and exit positions with minimal price impact. And it's typically going to be safe to use market order to get in and out, except in great times of great volatility. Per se, there's a market event or a flash crash, then you're going to want to be wary with a limit order and protect yourself. Moving on to volatility, for small cap tokens, due to their lower market cap and typically less liquidity, small cap tokens tend to exhibit higher volatility. So in general terms, that means their prices can move significantly in short periods of time. For your large cap tokens, less volatile than their small cap brothers. And that's because they have more liquidity, they have a deeper market, and just generally speaking, that's going to make them more stable in the overall market. Speaking to the market dynamics now, for small cap tokens, they commonly experience rapid price movements, typically generated by news, developments with the token, like the team or new aspects and utilities putting out, or just general market sentiment. They're often influenced by speculation and definitely more susceptible to a pump and dump schemes. Examples of this could be like risky meme coins like Elon, MOG, COQ that really don't have a lot of inherent value. So large cap tokens typically have market movements that are more stable, and they're influenced by broader factors such as regulatory news, institutional adoption, and also the overall market sentiment. So the inception of the ETFs on the equity markets for BTC and ETH, and then also the upcoming halving event for BTC, has really kind of spurred interest into the market over the past few months, and to what I believe has led Bitcoin to reach new all-time high. And speak to due diligence now. Now, for small cap tokens, you really need to have a thorough due diligence process, since they may lack extensive historical data or have an established track record. So you really need to look and assess the project's fundamentals, the team behind it, their technology, and put everything together and come up with their overall market potential. I would recommend reading the project's white paper. It's really boring at times, but it has the most in-depth information on the project. Now, for large cap tokens, due diligence is a lot easier because typically it's going to be a lot more information available just due to the established status of those tokens in the market. So investors are going to be able to analyze factors such as network activity, developer activity, partnerships, and institutional interest from a variety of reputable sources. We'll now touch on risk and reward. Now, for small cap tokens, they can offer higher potential returns, but with that also comes increased risk, just due to them being susceptible to higher volatility, lower liquidity, and generally higher probability for projects to fail for a variety of reasons. Be it lack of funding, no traction in the market, or in bad cases even fraud. Now, trading large cap tokens is generally considered less risky due to their established status, wider adoption, and higher liquidity. However, the potential for significant gains can be lower compared to the small cap tokens. So small caps can be profitably traded on a short term. However, large caps are more suitable for a long-term investment. And I say that loosely. You can trade large caps, with leverage, and you can trade them and still make sizable gains that you would have made trading a small cap token. But with that leverage also comes risk, and you have to be careful of that, especially if you're going to be leveraging a small cap token. Wrap it all up here. For small cap tokens, generally they're going to have a market cap of under 500 million. There's going to be thinner markets, so you're going to see wider bid-ask spread. They're going to have a high beta, so they're going to be more volatile. They're generally unstable, and highly influenced by any rumors or anything that comes out in the news, even if there's no substance to it. There's going to be less info available on these tokens that are newer, so there's going to be less institutions looking into it, creating research, and lastly, there's high risk and there's high reward in trading these tokens. They move fast, they move hard, and some of them, like the meme tokens, inherently have no value. Now, moving on to large cap tokens. Generally, we're gonna in the top 100, we're gonna see everyone above $1 million in their market cap. There's going to be narrow bid-ask spread, so there's going to be breadth to the market, and there's going to be a lot higher volumes than you would see in the small cap. So you can generally get away with doing a market order here, to enter and exit. Whereas with small caps, you really want to protect yourself with the limit orders. It's going to have a lower beta, so it's going to be lower vol than the small caps. Generally more stable markets, based on true dynamics like the fundamentals. You have institutional coverage, and with that is going to come higher quality of data. And from reputable sources as well. And lastly, there's going to be a lower risk reward. These tokens have a track record, they've proven themselves, and there's a more peace of mind placing money in something like BTC and ETH that now actually even have a backing on equity markets with the ETFs.